All right, let's get right into it. Today, we are unpacking a fascinating story about how one company, MicroStrategy, and its very well-known leader, Michael Saylor, are pulling off a financial strategy that is, well, it's so bold, it's kind of blurring the lines between tech, corporate finance, and even banking itself. Now, on the surface, this is a story about a massive bet on Bitcoin, right? But the real magic, the part you need to understand, is in how they're paying for it all. And listen, that is not an exaggeration. This quote really gets to the heart of what's going on. Saylor and his team, they're not just playing the game. They are actively trying to rewrite a part of the rulebook, and it's forcing Wall Street to sit up and pay very close attention. So the question is, how on earth are they actually doing it? Well, it all starts with this just staggering number, over 670,000 Bitcoin. To give you some sense of scale, that is a truly colossal digital treasury. But, just buying and holding the asset, that's not the whole story here. Not even close. The real genius, the innovation, is in how they use it, how they leverage it. So first up, storming the big banks. Now, you'd probably expect a company that's all in on Bitcoin to be, fighting against Wall Street. But MicroStrategy is doing the exact opposite. They are partnering up with giants. We're talking Morgan Stanley, JP Morgan, in what is a really brilliant strategic move. So here's the core of the strategy. MicroStrategy is essentially using its mountain of Bitcoin as a foundation to create brand new financial products. And then, and this is the key part, they're using the bank's regulatory licenses and their massive global infrastructure to get those products out to the world. It's a way for them to tap into revenue streams they could never, ever reach on their own. Okay, next, we have to break down the two sides of their financial coin, which is capital versus credit. I'm telling you, if you can grasp the difference between these two things, you'll understand the entire strategy. It's that important. Okay, think of it like this. On one side, you have digital capital. That's the Bitcoin. It's the bedrock, the underlying asset. It's volatile, and it's really designed to be held for a long, long time. But on the other side, you've got digital credit, something like their product called Stretch. It's engineered to be the complete opposite, stable, predictable, and designed to generate short-term cash flow. So one is the deep storage of value. The other is the financial machine, humming along right on top of it. And if you want to see what this looks like in the real world, check this out. In this one specific 4-month window, if you would put a $100 in a Bitcoin, you would have lost value. But $100 in their credit product, it actually paid you. As Saylor himself puts it, if you need your money tomorrow, you want the credit. If you can wait 4 years, you want the capital. It's all about giving investors options. Now, this entire strategy didn't just pop up out of thin air. According to Saylor, it was actually born from what looked like a weakness at first. A bug, he calls it, in their financial setup. But they managed to brilliantly flip it and turn that bug into the central feature of their entire business. And there it is, straight from the man himself. The bug was that they had to offer a really high-yield credit product just to get investors in the door. That's a huge cost, right? But then they had this light bulb moment where they realized that this high cost could be reframed as their single greatest strength. So how'd they do it? It really came down to 3 brilliant moves. First, they just leaned into the bug. They embraced paying that high dividend. Second, they took these products public, which made them way more accessible and liquid. And third, they structured the whole thing so the dividends would be tax-deferred. That is a massive incentive for certain investors. And just like that, the bug became the feature. And this leads us to what might be the most disruptive idea of all. For MicroStrategy, the credit they're issuing, it isn't just a tool to raise money. No, it is the product. This is a fundamental, ground-up shift from how pretty much every other major company on the planet operates. Just look at the difference here. A company like Apple or Microsoft, they borrow money when they need to. It's tactical. Their whole goal is to get the cheapest financing possible to build a data center or something. They create what Saylor calls crippled credit. It's designed to be good for them, the company. MicroStrategy, they do the exact opposite. Their whole mission is to create the best possible credit for the investor, because attracting that investor's money is the business. And I mean, you heard them. They inadvertently flipped it on its head. They just took the standard corporate playbook, which is, minimize costs for the company, and they turned it upside down to maximize the yield for the investor. It's a total paradigm shift. So why can they get away with this? What's the secret? It's because unlike basically any other company, they have a very unique plan for the money they raise. They use it to buy an asset, Bitcoin,
that they believe will appreciate much faster than the high yield they're paying out. Their forever time horizon changes the entire game. All right, so we've laid out all the puzzle pieces. We've got the massive Bitcoin treasury, we've got the partnerships with the banks, and we have this credit as a product model. So now let's snap them all together and see the final picture, the ultimate goal of this incredibly complex financial machine.
This is the engine. Here's how it's designed to work. The plan, as Saylor lays it out, is to issue new credit that's equal to about 10% of their Bitcoin holdings every single year. They take the cash from that, they buy more Bitcoin, and they add it to the pile. This creates this incredibly powerful feedback loop, a BTC yield, if you will, that just systematically increases the amount of Bitcoin backing every single share of their stock. The goal over time is to double their Bitcoin per share about every 7 years, effectively turning their stock into what they call amplified Bitcoin. So what's the bottom line for an investor who buys into this? What's the prize? It's the potential to 2 or even 3 times their exposure to Bitcoin over the long run, compared to if they just bought and held the asset themselves. It is, for sure, a leveraged play, but it's one that's driven by this unique credit machine instead of by traditional debt. And so that leaves us with this massive question. Is what Michael Saylor is doing here a revolutionary new model for how companies manage their money? Is this a blueprint for how digital assets will be used in the future? Or is it just one of the biggest, most complex, high-stakes gambles of all time that really hinges on just one thing, the long-term success of Bitcoin? Well, that's a story that is still being written.